Hello and welcome to the Margin of Sanity podcast. In this episode, I'm going to break down one of my core positions, Eagle Materials, ticker symbol EXP. This is also a newer position of mine and a far cry from some of my other core positions like Taiwan Semiconductor, Amazon, and Visa. Eagle Materials is a cement and building materials company, and one that has a long history of exceptional management and financial performance. In this episode, I'll explain why I got so interested in this company, break down the economic characteristics of the cement business, and dive into detail on how Eagle Materials manages to achieve such exceptional returns in such an unexceptional business. I'm still just getting started here, and if you appreciate the work, please drop a comment, a like, or a restack so other people can find it. If you're listening on a podcast player like Spotify or Apple Podcasts, just know that this entire write-up is available totally free on the Margin of Sanity Substack. I'll drop a link in the show notes. All right, cement. Let's get into it. So often, investors focus on what changes in the world. Such and such may be the dominant technology today, but once XYZ happens, that could change. Disruption has become the new .com, and investors are constantly on the watch for any and every new idea that will change the game. Will self-driving cars make Uber obsolete? Or will Uber's network abilities position it as the winner of the self-driving revolution? Will Google lose its search business to LLMs, or will LLMs make Google's search business just that bit more powerful? What about Airbnb versus hotels, or renewables versus fossil fuels? There's so many questions. So much on the line, and so much money to be made in guessing correctly. But me, I don't like change. I hate thinking about change because it fundamentally requires making guesses about the future, something that seems easy in hindsight but proves virtually impossible in practice. Change is oftentimes unavoidable, but I find this to be a very frustrating starting place as an investor. I figure the less fortune-telling I'm forced to do, the better. Behind all, or at least most, of my investment ideas lies some bigger and more broad idea that I can cling to. I need a foundation that is solid before I can construct a winning thesis on top of it. So here is my big, revolutionary idea. Cement is heavy. That's it. The basis of my bet on cement has to do with the very quality that makes it useful in the first place. Its weight. You want to build a strong structure? You need cement. There's no easy way around humanity's need for cement, and much like the structures it helps build, cement ain't going anywhere. It's all around you, and it's the weight of that cement and the unit economics created by that weight that make up the foundation of my idea. Okay, bear with me here. Remember Newton's second law from physics class? F equals ma? That is, force equals mass times acceleration. But now let's flip it. A equals Fm. Acceleration is equal to the force divided by the mass. Think of force as the energy and therefore money needed to move a truck. Mass is the weight of what it's carrying, and acceleration is the increase in speed needed to, make it move. That means that as you increase mass, weight, you need more force, i.e. energy, and therefore money, to actually move that mass. This is the long way of saying you gotta pay big bucks to move heavy stuff. With raw materials like copper, coal, oil, etc., that isn't a big issue. Those things can be sold at a high enough price per ton that the cost to ship it isn't a deal breaker. Cement is another story, though. You need a lot of this stuff to build a structure, and fortunately, cement is proportionally cheap to produce per ton. That's great, unless you have to ship that cement. The cost of shipping cement starts becoming a big problem the further you move it. The cost of fuel alone significantly restricts how far you can transport that cement before your margins turn negative. I will go into more detail later on this dynamic, but the principle is the important thing here. Reason being that if cement producers can't make money shipping it, then the buyers have to buy it locally. The result? A highly fragmented and localized cement market. One in which the lowest cost local producer becomes a natural monopoly. All of that information can actually be found in the annual report for the company I'm talking about today, Eagle Materials, ticker symbol EXP. But first, let's talk about cement itself. What is cement, anyways? Well, basically, it's a key ingredient in the making of concrete. I've accidentally written the word concrete when I meant to say cement at least 10 times by now, so thank God for Command F. Think of it like this. Cement is the flour and concrete is the cake itself. Fortunately for Eagle Materials shareholders, there is no gluten-free option for concrete. But back to cement. Okay, so you want to make some cement? Easy. Go get some limestone and clay, or shale, and grind it up. Then put it in a kiln and heat it to about 1,450 degrees Celsius. Then you'll have something called clinker. Mix that clinker with gypsum, a very common mineral, and presto, you have cement. Add some water and you'll get a very heavy goop that will eventually dry and harden into something akin to stone. When cement hardens, it looks suspiciously like Portland stone from England, which is why the most common type of cement is called Portland cement. So if that's cement, then what is concrete? Well, like I said, cement is just the flour, and concrete is the cake. So if you want to make concrete, just take your cement and mix it with water, sand, and gravel, called aggregates. You mix the glue-like cement with what amounts to sand and rocks, and you end up with another stone-like material called concrete. So if you're driving down a concrete highway, you're basically driving on rocks and gravel, aggregates, being held together by cement. And those giant trucks you see with the giant spinning mixer, well, that's concrete being mixed before it arrives on the job site, ready to pour. So while cement has a few uses besides being the sole binding agent in concrete, the vast majority, about 97% of cement, is put to use in the making of concrete. Okay, so what do we need all this concrete for? Well, concrete has a way of showing up almost everywhere you look in the building environment. It serves as the anchor for the foundations and floor slabs of houses, apartment towers, office blocks, hospitals, stadiums, schools, data centers, and warehouses, while forming the tilt-up walls and precast columns that let those structures rise quickly. Moreover, concrete, and therefore cement, is the backbone of our transportation system. Think concrete highways, city streets, airport runways, bridge decks, piers, abutments, cable stay pylons, whatever that is, railway ties, ballastless track beds, and the heavy quay walls of our ports. But what about the stuff you don't see in your daily life, like civil engineering megaprojects? Well, they rely on cement too. Imagine all the cement needed for gravity dams and spillways, flood control levees, canal locks, storm surge barriers, water and wastewater treatment plants, underground tunnels and subway linings, as well as the gigantic silos, containment berms, and the industrial floors of refineries. Liquid natural gas terminals, petrochemical complexes, and power stations all require vast amounts of cement. Hey, speaking of power, cement also plays a role in the energy sector. Cement secures oil and gas well casings deep underground, forms the massive pads for wind turbines and transmission towers, and provides the heavy foundations for solar tracker arrays. Roller compacted and ultra-high performance concrete derived from Portland cement make it possible to build rapid replacement dams, long-span bridge girders, and blast-resistant panels and thin architectural facades. And finally, closer to home, cement ends up in driveways, patios, sidewalks, curbs, retaining walls, swimming pool shells, masonry mortar and grout, and in Shot Creek, sprayed onto basement walls, tunnel roofs, or steep slopes to keep the ground in place. In short, if a structure must be rigid, durable, and able to handle compression or weather, Portland cement-made concrete is the sole material that makes it possible. Have I convinced you cement is important? Okay, so you're thinking, I get it. Cement is everywhere, but it's also a commodity. One truckload of cement is basically as good as another. And while I'm sure that's mostly true, my thesis doesn't rely on one company having some special cement patent or anything. Moreover, Eagle Materials doesn't have a fancy brand that builders trust either. Instead, what they have is control of the supply chain in all the geographies they operate in. They have their own limestone, clay, and gypsum reserves that enable them to produce a finished product at a lower cost than the competition. This makes them the lowest cost producer wherever they operate. And I'm going to say that again because it's so important. Eagle Materials is the lowest cost producer of cement because there aren't four other companies all taking a cut on the production and delivery of the raw materials needed to make that cement. This is what people in nicer suits than me call vertical integration. When you sell a somewhat fungible type commodity, i.e., cement, it's tricky to really compete on anything besides price. This means that wherever Eagle operates, it's a powerful little monopoly. Now, usually US producers are not the lowest cost producer of anything. Somewhere in the world, there always seems to be someone else making something cheaper, which really is the most important quality of a truly fungible commodity. But as I mentioned at the beginning, there is also a basic law of physics which restricts people in faraway places from transporting cement to Dallas or Oklahoma and making a profit on it. This discrepancy between weight and cost to transport forces concrete, and therefore cement, to remain a highly localized and fragmented business. When I said faraway places earlier, I really just meant 150 miles away or less. That's 50 miles shorter than the distance between New York City and Boston. After that, you're losing money on your concrete. Crazy, right? In their 2024 annual report, Eagle's management puts it like this, quote, "Because of cement's low value-to-weight ratio, the relative cost of transporting cement on land is high and limits the geographic area in which each company can profitably market its products. The low value-to-weight ratio generally limits shipments by truck to a 150-mile radius from each plant, up to 300 miles by rail, and further by barge. Consequently, the U.S. cement industry is made up of regional markets rather than a single national selling market." End quote. Now imagine trying to transport your product even just 75 miles, and when you show up, Eagle Materials is still outbidding you because they've already spent 2 decades refining their operations, buying up limestone mines that make your already thin margins look even thinner. Better to avoid the competition than take on losses. But hey, if you want to run your business into the ground, that's fine with Eagle too. They'll wait patiently until the building cycle in your region hits a gully and just buy you out, at a steep discount, I should add. See, Eagle doesn't just operate in one place. If business gets tough in Missouri, they can use the profits from their Gulf Coast operations to make opportunistic acquisitions in Missouri. You may already be thinking that the cement business must be pretty capital intensive, right? And while that is very much true, Eagle's high ROE tells a story of a company that deploys its capital very efficiently over time. So the capital intensity of the cement business ends up serving as yet another moat, further protecting Eagle's dominant position. We'll get into financial metrics a little later, but first, let's quickly back up and break down Eagle's business segments from 2024. The largest segment is heavy materials, which is cement, concrete, and aggregates, and that makes up 60% of their revenue. The cement business is 52% of their total revenue, and the concrete and aggregates business is 10%. And then we have the light materials segment, which is 40% of their total revenue. Gypsum wallboard or drywall is 33%, and recycled paperboard is 5%. As you can see, cement and wallboard make up a collective 85% of the business, which is why I'm not spending much time on paperboard. That said, when it comes to concrete and aggregates, Eagle is happy to make acquisitions and grow this segment, so long as the price is right. Since cement is the key ingredient in concrete, you can imagine the cost advantages of combining the output of a cement plant with that of an aggregates quarry or pit mine. Moreover, that value-to-weight ratio principle applies to all of their business segments, besides maybe that of the small paperboard business. Wallboard may have a bit of a larger profitable radius, about 300 miles, but the fundamental idea remains intact. Ultimately, it's this physics-restricted unit economics that enables Eagle to stay patient with their acquisitions and compete only with the more fragmented, less efficient local producers. While it's true that, just like their competition, Eagle can't move its product across the country from one plant to another, they can move their capital wherever they like. On top of that, Eagle Materials is able to invest in, quote, state-of-the-art technology that lifts throughput, trims energy, and lowers carbon. That's from management in the 10K. Everything from better equipment to dispatch GPS systems helps Eagle meet the growing needs of their customers, satisfy emission standards of regulators, and reduce waste, thereby improving their margins and their core business strength. One might think higher emission standards would hurt Eagle's business, but it basically does the opposite. Eagle can afford to make these upgrades responsibly while many local producers simply can't. In many ways, when things get difficult for the cement business in the short term, Eagle actually benefits in the long run. Management talks about doubling earnings from peak to peak, a goal they've accomplished repeatedly. They can do this because they have the scale, balance sheet, and geographic diversification that regional competitors lack. I always think about the wolf and the three little piggies, two of which have houses made of sticks. But then there's that third piggy, the one with the house made of stone, which is most likely held together by cement. And that's Eagle Materials. Of course, no one wants a wolf to come around and start destroying property value. But if the third little piggy was a true capitalist, he would see the opportunity to acquire the land of the other two piggies at a steep discount. Now, I'm not sure if pigs engage in share buybacks, but Eagle certainly does. Whenever the stock gets cheap or management has extra capital lying around, they either buy up their competitors' assets or they buy back shares. It's rare-ish that the entire U.S. materials segment suffers all at once. So Eagle usually has plenty of cash coming in the door from other operations to take advantage of any weakness in a specific regional market. They can use their capital, scale, and expertise to revamp the beaten-down asset. Let's talk about geography for a minute. Eagle Materials conveniently focuses on those regions that are growing faster than the rest of the country. I can probably let management explain this one. Quote, "Demand for our products depends on construction activity, which tends to correlate with population growth. While the company's market includes most of the United States except the Northeast, approximately 65% of our total revenue is generated in 10 states: Colorado, Illinois, Kansas, Kentucky, Missouri, Nebraska, Nevada, Ohio, Oklahoma, and Texas. Population growth is a major driver of construction products and building materials demand. The population in these 10 states is expected to increase approximately 11% between the 2020 census and the 2050, compared with 7% for the United States as a whole, according to the latest update in February 2024 by Moody's Analytics." End quote. I think it's funny that despite being on completely opposite sides of the political aisle, both Biden and Trump seem to need more of one thing: cement. Biden's large-scale infrastructure spending bills and Trump's push for U.S. reindustrialization both require a ton of cement. The tailwinds of such policies are long-lasting and create tailwinds of their own. Of course, if you want to build a factory, you need cement, but there's always more to it than that. You also need a parking lot, roads to the factory, infrastructure to power the factory, drainage around the factory, housing for all the people working at the factory, and of course all of those new houses will need sheetrock in the walls and concrete in the driveways. I guess the point I'm trying to make is that development begets more development, and development always requires cement. Moving on. Gypsum wallboard. What is it and what is it good for? I feel obligated to explain a bit about the other major segment of Eagle Materials' business, that is, the gypsum wallboard segment, which is about 33% of 2024's revenue. You may not have heard of gypsum wallboard before, but you probably know about drywall or sheetrock. All three of those are different names for the same thing. If you were to punch your wall right now, there is a 97% chance that the material you break your hand on will be sheetrock/drywall/gypsum wallboard. Remember that they're all the same thing. I say 97% because there is also a 3% chance you hit plasterboard, which is different and also an inferior material we no longer really use to build homes. I should clarify, though, that these percentages actually refer to new constructions and not old ones. Back in the day, plasterboard was more prevalent. But by now, basically all new construction involves walls made exclusively from drywall, or sheetrock, or gypsum wallboard, whatever you want to call it. Remember gypsum? It's one of those key ingredients you need to make cement. So perhaps you're already thinking how convenient it is that Eagle Materials needs gypsum for both of its large business segments. Fortunately for you, I don't really need to explain much about wallboard that you don't already know about cement. The same principles apply here as did to the cement business: value to weight ratio, fragmented market, vertical integration, and irreplaceability. Eagle owns and operates 5 different gypsum wallboard plants, and 4 of those 5 are supplied with gypsum from Eagle's own quarries. Much like the limestone mines supplying their cement plants, The gypsum quarries for Eagle's sheetrock business allows them to compete on the ever-important metric of price. Yet again, Eagle finds themselves the lowest cost producer in their regional market. While there are seemingly infinite uses for cement, sheetrock is really only good for two things: walls and ceilings. As a result, Eagle's gypsum wallboard segment sees its demand coming from four markets: residential construction, repair and remodel, non-residential construction, and manufactured housing. As you would imagine, these markets ebb and flow with population growth, economic development, and the housing market in general. All right, let's get to some numbers. Now that you understand the game and the playing field, let's take a look at the scoreboard for a moment. It's one thing to have a qualitative understanding of a business's advantages, but they still need to translate into healthy financial figures. Fortunately, this is very much the case for Eagle Materials. The story told by the company's financial statements is one of solid revenue growth, expanding margins, a healthy balance sheet, high returns on equity, and a consequential 14% annualized earnings per share growth rate over 10 years. They pay a very modest 0.5% dividend as well, but I choose to ignore that. So, I'm also not going to talk about EBITDA because it's insane to look at a capital-intensive business like cement without accounting for depreciation, or interest for that matter. Okay, let's break it down starting with the top line. Over a 10-year period, EXP's compound annual growth rate for revenue was 7.8%, and over 5 years it was 10%. Below is a chart showing their revenue going back 15 years to 2010. Now is a good time to remind you that this write-up is available totally free to read on the Margin of Sanity Substack, and you can see all of these charts in that write-up. All right, now let's take a look at the margins. According to Google, the industry average gross margin for cement is 5 to 10%. For Eagle Materials, it is a whopping 30%. And if you think that 30% gross margin gets eaten away by operating costs, taxes, or interest, you are sorely mistaken. Eagle's net profit margin has grown to a fairly juicy and stable 20%. For any business, a 20% margin is great, but for a cement company, that's really good. If you didn't believe in my opportunistic little piggy story, let's take a look at Eagle's ROE. For a business that is fundamentally capital intensive, this chart depicts true capital allocation discipline on the part of management. For those only listening, you can see the return on equity metric for Eagle Materials increasing from 2010 to today and ending up at about a 32% ROE. A 32% ROE is excellent considering debt is only 2 times net income. That means that despite acquisitions and CapEx, Eagle gets a marvelous return on the capital they deploy. And what about buybacks? Well, here is yet another chart showing EXP's shares outstanding declining 34% over 10 years from 50 million in 2015 to 33 million today. Moreover, the balance sheet is healthy, with net debt equal to less than 2 years of net income, which is about my sweet spot. And all of this gets you a 10-year annualized earnings per share growth rate of 14%. So what about valuation? Today, you can buy EXP for 15.6 times their trailing 12 months earnings and 13.7 times forward earnings. Let's forget the forward figures for a minute. As of today, with a share price of $215, Eagle Materials sells for a pre-tax earnings yield of 8%. That means that, assuming no growth in the business, you get 8% on your money. Not amazing, but not a premium either. Below is a chart of EXP's historical trailing 12 months PE ratio. Historically, it does look a little bit cheap, although probably 15.6 times earnings is only average over the last 5 years. Maybe not a screaming bargain relative to history, but certainly a great value for what I get. Ultimately, I absolutely expect earnings to continue to grow at their historical average, if not faster. But it's nice to know I'm not paying up for that growth like I would in the tech sector. It's also nice to know that some new AI startup won't come out of the darkness and eat the business. Even if Tesla's Optimus robots end up working construction, they'll still be building with cement. Parting thoughts. While cement may be one of the most mundane businesses on earth, the way Eagle operates within that segment is remarkable. Its margins trounce the averages, and its ROE looks better than plenty of other, more high-tech businesses. These wonderful returns aren't a fluke either. They're a result of structural unit economics within the cement industry, a battlefield in which Eagle has the high ground, and knows it too. No one looks at concrete and imagines high returns, so the business is perpetually undervalued. That would be a bad thing if management didn't happily buy back its shares at that cheaper price. Without any real competition on the horizon, Eagle can focus on opportunistic acquisitions that firm up their position as a regional monopoly and expand their reach into new markets. Moreover, bad news is good news for these guys. Whenever we enter the next recession, I'll be able to sit back comfortably, knowing that Eagle is probably making better investments than they were before. 14% earnings per share growth rate may not seem groundbreaking, but for me that is a wonderful return considering how confident I am in actually receiving it. Eagle is a company I own a lot of, and it's one I plan to hold for the long term. It has a long runway of growth ahead of it, and I love the business, the management, the numbers, and the valuation. All of that earns it a place as a core position in my portfolio. A lot can change in this world, but the material foundation of our civilization is fixed, cast in stone, and held together by cement. Credit where credit is due. I didn't find Eagle Materials by accident. I heard about it from the Special Situation Investing Substack, which I highly recommend. While those guys didn't end up buying Eagle Materials, their write-up was enough to make me curious. After some research and pontification, I started buying Eagle in early 2025 and added to the position during the tariff sell-off. I also recently added more after Eagle missed analyst expectations on the last quarter and the price dipped a little. And a quick note regarding earnings expectations, by the way, it's important to know that only 3 analysts are actually making those predictions for Eagle, so beware the forward-looking metrics in this case in particular. Thanks for listening to the Margin of Sanity podcast. Just another reminder that this is available on the Margin of Sanity Substack, totally free. If you've gotten any value out of this show, please go ahead and drop a like or a 5-star review, or even better, a comment or review of the show. It really does help other people find it. I'm just getting started here, so that engagement really does help. Until next time, this is the Margin of Sanity podcast.